All right, let's dive right in. Today, we are opening up the Smart Money Playbook. This is all about understanding how the real heavy hitters in the financial markets operate, so you can start to think like they do. So let me ask you this. Have you ever been in this situation? You've done all your homework, the chart looks perfect, you find what you think is the ideal entry, you place your trade feeling great, and then, boom, the market just turns on a dime and does the exact opposite of what you predicted. It is just so frustrating, right? And here's the absolute classic move. The price dips just far enough to hit your stop loss, kicks you out of the trade for a small loss, and then almost immediately it snaps back and takes off like a rocket in the direction you knew it was going to go. So you were right the whole time, but you still ended up losing money.
Well, what if I told you that wasn't just bad luck? What if that was an intentional, calculated move? This kind of thing is actually a super common tactic used by what we call smart money. They do it to create liquidity for their own massive positions. And understanding this is the absolute first step to trading with them, instead of being the one they're trading against.
Okay, so if we're going to start thinking like the big players, we have to learn to see the market through their eyes. And that brings us to our first section. We're going to decode supply and demand. This is really the foundation for everything else we'll talk about. First up, who exactly is this smart money? Well, we're talking about the giants of the financial world, the big banks, the huge institutional funds, the massive hedge funds. These guys have so much capital that their orders don't just participate in the market, their orders are what move the market. Now, because their positions are so huge, they can't just mash the buy button for $1 billion worth of an asset. That would send the price flying and ruin their own entry. So they have to be sneaky. They place their orders in very specific areas where there's a ton of liquidity. We call these areas supply and demand zones, and they're basically the footprint smart money leaves behind on the chart for us to find.
Now, I know what you might be thinking. Wait a minute, this just sounds like support and resistance. And you're close, but there is one absolutely critical difference. Support and resistance levels are formed after the prices hit a level and bounced off it multiple times. But supply and demand zones, they're created by a single, sharp, explosive move away from a price level. It's a totally different origin story.
So how do you actually spot these things? It's actually pretty simple. You just scan your chart for an area where the price just took off, either shooting straight up or dropping like a rock. That aggressive move is your clue. It tells you there was a massive imbalance of orders right there. Basically, smart money stepped in. So you can think of a demand zone as a fresh, untested support level and a supply zone as a fresh, untested resistance level.
All right, so now we can find the footprints. The next piece of the puzzle is understanding the context, right? The broader story. So let's move on to section 2, reading the market story. This is all about understanding market structure.
You know, market structure is really just the narrative of the chart. Is the price trending up? Is it trending down? Or is it just chopping around sideways? By learning to read the structure, we can figure out what the market is trying to do and make sure we're swimming with the current, not against it. A healthy, bullish uptrend has a very specific rhythm. You'll see the price push up to make a new high. We call that a higher high. Then it'll pull back a bit, but it will find support above its previous low point, creating a higher low. This repeating pattern, this dance of higher highs and higher lows, is the clear signature of a market that wants to go up. And you guessed it, a downtrend is just the mirror image. The market will push down to create a new lower low. Then it'll rally a little big, but that rally will stop below the previous peak, creating a lower high. This staircase down pattern of lower highs and lower lows tells you that the sellers are firmly in control. So how do we know if the trend is still healthy and moving along? We look for what's called a break of structure, or BOS for short. In an uptrend, a break of structure happens when the price smashes through the previous high. In a downtrend, it's when price breaks below the previous low. Every time you see a BOS, it's the market confirming that, yep, the story is continuing as planned. But you know, even the best stories have a plot twist. And in trading, the plot twist is often where the biggest opportunities are. So that brings us to section 3, spotting the plot twist. This is where things get really interesting. Just picture this on a chart. The market is in a beautiful, clean downtrend. It's making lower lows, lower highs, lower lows, lower highs. You know, rinse and repeat. It's predictable, it's orderly, everything is going just as you'd expect. But then, something changes.
the price fails to make a new lower low. And not only that, on the next rally up, it doesn't just stop at a lower high, it actually pushes right through the previous high. The whole pattern that's been working is suddenly broken. What does that tell us?
That right there is what we call a change of character, or COCH. Think of it as the market raising its hand and saying, hey, something's different now. It's the very first clue, the earliest warning sign we get that the old trend might be running out of steam and a new one is about to begin. This is our signal to sit up and pay very, very close attention.
Okay, so we can find the zones, we can read the overall story, and we know how to spot the critical plot twist. It's time to put all these pieces together into a concrete, actionable plan. Let's get into Section 4, the Smart Money Playbook.
The entire strategy really boils down to just 3 simple steps. Step 1, identify the market structure. Are we trending up, trending down, or did we just see a change of character? Step 2, you mark out your key supply and demand zones on the chart. And step 3, and this is easily the most important step of all, you wait. You patiently wait for the price to come to one of your zones and give you a clear confirmation signal before you even think about clicking a button.
So let's walk through a buy setup. Let's say the market is in a clear uptrend making those higher highs and higher lows. Price pulls back right into a nice demand zone that we've already marked out. We don't just buy here, we wait. Then we see a big, strong, bullish engulfing candle form right inside our zone. That's our confirmation. That's the market telling us the buyers are stepping in right here. Now we can take that buy trade.
Okay, how about a sell? We spot a change of character, where a nice uptrend suddenly breaks down, signaling a potential reversal. Price then rallies back up into a fresh supply zone. Again, we wait. Suddenly, a bearish pin bar forms, showing us a strong rejection of that higher price. That's the signal we were waiting for. Now we can enter a sell position with much more confidence.
I really cannot stress this enough. Confirmation is absolutely everything. A supplier demand zone is just an area of interest. It is not a brick wall. The source material is very clear on this. If you just blindly set an order as soon as price touches your zone, you are asking for trouble. You have to wait for the market to prove you're right before you commit. Patience is what separates the pros from the amateurs.
And finally, we have to bring this all back down to earth. This quote from the source says it all perfectly. There is no magic bullet in trading. No strategy works 100% of the time. You are going to have losing trades, period. And that's exactly why solid risk management and always using a proper stop loss on every single trade is completely non-negotiable.
So there you have it. We've learned how to find the footprints of smart money, how to read the market's ongoing story, and how to spot the plot twists. The charts aren't just random lines anymore, they're a narrative of conflict between buyers and sellers. The only question left is, now that you know how to read the signs, what story are you going to see?